Thanks for joining us today at the Mining News Network podcast. Let's get started.
Hey everyone, and welcome back for another deep dive. Today we are going to be tackling a question about mining investments.
Okay.
Specifically, how streaming and royalty models, how they compare to traditional mining stocks.
Right.
We had a listener write in who was curious about how they benefit both the mining companies and investors kind of differently.
Yep.
And we've got some great material to dig into for this. We've got excerpts from a McKinsey report
Okay.
on the rise of streaming and royalty financing and mining,
Cool.
and a Forbes article. That makes a pretty compelling case for royalty companies.
Awesome.
And get this, the McKinsey report highlights that streaming and royalty deals generated over $15 billion in 2019,
Wow.
which is a massive leap from just over $2 billion in 2010.
Yeah, that's a huge jump.
So clearly something big is happening here.
It is a remarkable shift. What we're seeing is a growing recognition of the value these alternative financing models bring to the table.
Okay.
They address some of the inherent challenges in the mining industry, offering a win-win for both miners seeking capital and investors seeking exposure to commodities.
Okay, so let's break it down. Before we go any further, can you give us a quick rundown of what streaming and royalty deals actually are?
Absolutely. Both involve a mining company receiving an upfront payment
Okay.
in exchange for a portion of their future production or revenue. So think of it as pre-selling a portion of their future output.
Okay.
Now, the key difference lies in what's being sold. With streaming, the focus is on a specific commodity,
Gotcha.
often a byproduct of the mine's primary output.
Okay.
It's like a band getting an upfront payment for their next album.
Okay.
They get the cash, regardless of how well the album sells.
I like that analogy.
All right.
So the band is covered even if the album flops. What about royalties then?
Royalties are tied to the overall revenue of a mining project. It's as if the band receives a cut of every concert ticket sold, no matter what songs they play.
Okay.
They're sharing in the overall success of the venture.
That clarifies the distinction. Right. So why are we seeing more and more mining companies opting for these models instead of traditional financing?
Well, the 2014 commodity downturn played a significant role. Traditional financing, especially debt, became much harder to come by.
Yeah.
Mining companies had to get creative,
Right.
and streaming and royalty deals offered a lifeline.
Okay.
As the McKinsey report points out, these deals are inherently less risky than taking on more debt.
Right.
And unlike issuing more equity, which dilutes existing shareholders' ownership, streaming and royalty arrangements have a much smaller impact on the company's ownership structure.
That makes a lot of sense. But wouldn't a mining company prefer to keep all the profits from their project? Why share the wealth?
That's where it gets strategically interesting.
Okay.
The McKinsey report highlights a crucial point. These models are particularly beneficial when dealing with non-core products.
Okay.
Let's say a company's main focus is copper, but their mine also yields gold as a byproduct. They may not want to divert resources to fully exploit that gold. Streaming allows them to monetize that gold up front, giving them the capital to focus on what they do best, producing copper.
Yeah.
It's a way to unlock value from assets that might otherwise be underutilized.
So it's about focusing on your strengths and leveraging underutilized assets.
Exactly.
Interesting. Now, switching gears to the investor side.
All right.
What's the appeal of royalty companies compared to traditional mining stocks?
The Forbes article we have dives into this beautifully. Royalty companies offer investors a unique proposition.
Okay.
Think of it this way. With a traditional mining stock, you're investing in a specific company and all its associated risks.
Yeah.
Operational challenges, exploration uncertainties, fluctuating production costs. It can be a roller coaster ride.
Right.
Royalty companies, on the other hand, are essentially taking a cut of the revenue generated by multiple mining projects.
Yep.
They offer exposure to commodity prices without the operational headaches.
So they offer a way to tap into the potential of rising commodity prices without having to bet on the success of a single mining operation.
Exactly.
That sounds like a less volatile approach.
Exactly, and here's the kicker.
Okay.
They often lock in below market purchase prices for the metals they're receiving.
Interesting.
So even if commodity prices fluctuate, their profit margins tend to remain healthy. This stability is a major draw for investors, especially those wary of the mining sector's inherent volatility.
It's like having your cake and eating it too.
Yeah.
Leveraging the upside potential of commodities while mitigating some of the downside risks.
Exactly.
No wonder investors are finding royalty companies so appealing.
Precisely. And remember, they're not carrying the burden of running mining operations.
Right, yeah.
They have leaner structures and often boast impressive profitability.
Yeah.
The Forbes article highlights that Wheaton Precious Metals generated $25.8 million in revenue per employee. That's a staggering difference in efficiency compared to major miners who have huge workforces and massive operating costs.
Wow. $25.8 million per employee.
Yeah,
That's incredible.
it is.
So they're lean, mean, profit-generating machines.
That's one way to put it.
And we all know what happens when companies generate strong profits: dividends.
Exactly.
The Forbes article really emphasized how generous royalty companies are with their dividend payouts. They're outpacing the S&P 500 and leaving traditional mining companies in the dust.
It's true. Their business model generates a consistent cash flow,
Yeah.
making them well-positioned to reward their shareholders. And remember, those dividends are often backed by real assets, the underlying gold, silver, or other metals.
Right.
It's a level of tangible backing that traditional mining stocks often struggle to match.
It's like holding a piece of the commodity itself, but without the hassle of storing it in your safe.
Exactly.
Okay, so we've seen how these models benefit both miners and investors differently, but let's shift gears a bit. Okay, are there any downsides for mining companies using streaming and royalty models?
Of course, there are always trade-offs. The most obvious downside is that they're giving up a portion of their future revenue or production.
Right.
They're essentially sharing the upside potential with the royalty or streaming company.
So it's a calculated decision.
Exactly.
They're getting upfront cash, but potentially sacrificing some future profits.
Precisely. They're weighing the certainty of immediate capital
Yeah.
against the possibility of higher future returns if they go it alone.
Right.
And for many companies, especially junior miners, still in the exploration and development phase, that upfront capital can be the difference between getting a project off the ground or watching it stall.
It's like choosing between a bird in hand and two in the bush.
Yeah, exactly.
Some of that bird in hand is exactly what you need to get things moving.
Exactly. The McKinsey report really emphasizes this point. These alternative models can be a game changer for smaller companies struggling to attract traditional financing. It allows them to focus on proving the value of their projects without the added pressure of hefty debt repayments.
Makes sense. But wouldn't larger, more established mining companies have an easier time securing traditional financing?
You'd think so, right?
Yeah.
But even major players are increasingly incorporating these models into their financing strategies. They might use them to fund specific projects or expansions without adding to their debt load or diluting their equity.
Right.
It offers a level of financial flexibility that can be quite attractive, even for companies with solid balance sheets.
So it's not just a lifeline for smaller players.
Right.
It's a strategic tool for the big guys, too.
Exactly.
It seems like these models are becoming increasingly mainstream in the mining world.
They are.
But let's zoom in on the royalty companies themselves. How do they decide which projects to back?
Okay.
It can't be as simple as throwing darts at a map and hoping for the best.
Absolutely not. They're not gamblers. They're highly specialized investors.
Right.
The McKinsey report actually outlines a very rigorous evaluation process. Okay.
That these companies use to assess potential projects. They look at 4 key types of risk: operational,
Okay.
geological, geographical and political,
Hey.
and financial.
Okay.
Each one is carefully considered before they commit any capital.
Okay, let's unpack those risks. Operational risk. What does that entail?
It's all about assessing the mining company's ability to execute the project effectively.
Okay.
They look at the management team's track record, the quality of the assets, and the mine's potential to operate profitably,
Right.
even when commodity prices are low.
Yeah.
Basically, they're asking, can this company deliver on its promises?
So it's about making sure the mining company has the experience, the resources, and the operational efficiency to make the project a success.
Exactly.
What about geological risk? That sounds like a big one, literally.
It is crucial. They need to be confident that the deposit itself is viable.
Right.
They evaluate the geological characteristics, making sure it can support the projected financial returns.
They also look at the potential for future exploration and expansion.
Yeah.
No one wants to invest in a mine that's going to run dry in a few years.
Right. You want to make sure there's enough gold or silver or whatever they're after
Right.
to make the project worthwhile.
Yeah.
And Geographical and political risk? I can imagine that being a major factor.
Yeah.
Especially with mining operations often located in politically volatile regions.
Absolutely. It's all about minimizing external risks.
Right.
They assess the political stability of the country where the mine is located,
Okay.
the legal and regulatory frameworks surrounding mining, and the potential for things like resource nationalism or export restrictions. Imagine investing in a project only to have the rug pulled out from under you by a sudden change in government policy.
Right.
That's the kind of scenario they're trying to avoid.
That's a smart move. Okay, last but not least, financial risk. What are they looking for there?
It's all about making sure the mining company is financially sound
Okay.
and can actually repay the investment. They assess the company's credit risk, their debt levels,
Right.
and the overall financial health of the project. Remember, these royalty and streaming companies are in it for the long haul.
Right.
They're looking for projects that will deliver stable and predictable cash flow for years, even decades to come.
Yeah.
They need to be confident in the financial viability of their partners.
So they're not just looking at the shiny rocks.
Right.
They're looking at the people, the politics, and the balance sheets.
All of it.
They're really doing their homework to make sure they're placing their bets wisely. And speaking of placing bets, we've talked a lot about the benefits of these models, but I think it's important to acknowledge that there are always risks involved in any investment.
Of course.
The Forbes article touched upon this as well, highlighting the importance of choosing the right royalty companies.
It's a crucial point. Just because a company operates in a seemingly attractive sector doesn't guarantee success.
Right.
Investors need to look beyond the hype and assess the fundamentals. Do they have a proven track record, a strong management team, a sound investment strategy? These are all critical questions to ask before committing your capital.
Right. It's about separating the wheat from the chaff, so to speak.
Exactly.
How can investors make sure they're picking the winners in the royalty space?
That's where due diligence comes in. It's essential to do your research, read financial reports, and understand the company's history, management team, and investment strategy.
Okay.
And remember, past performance is not necessarily indicative of future results.
Right.
The mining industry is cyclical and volatile, so you need to be comfortable with a certain level of risk.
So it's about being a discerning investor, not just jumping on the bandwagon because something sounds trendy or exciting.
Yeah.
It's about understanding the companies, the industry, and your own risk tolerance. Solid advice. But let's shift our focus back to the broader industry for a moment. Where is this whole streaming and royalty sector headed?
Okay.
Is this just a passing trend, or is it something bigger?
The McKinsey report suggests we're just scratching the surface. They point out that these models currently represent a tiny fraction of overall mining financing,
Okay.
which means there's a huge potential for growth.
So there's still plenty of room to run?
Absolutely. And several factors are converging to create a perfect storm for this industry to flourish.
Right.
We're seeing increasing investor demand for direct commodity exposure as a hedge against inflation and economic uncertainty. At the same time, the world needs more mining projects to meet the growing demand for metals,
Right.
driven by global population growth and industrialization.
And let's not forget the elephant in the room.
Yeah.
The clean energy transition.
Right.
The demand for battery metals like lithium, cobalt, and nickel is exploding.
It is.
Traditional mining might struggle to keep up with this surge in demand.
Yeah.
Could streaming and royalty deals help fill the gap?
That's a fascinating question, and it's one that the McKinsey report specifically addresses. They argue that these alternative financing models could play a vital role in unlocking the capital needed to develop new mines for these critical minerals.
Right.
Imagine a world where streaming and royalty companies become key enablers of the clean energy revolution.
Wow.
It's not just about making money, it's about potentially contributing to a more sustainable future.
Wow, that's a powerful thought. It's like investing with a purpose. But let's be realistic. There are always two sides to every coin. What are some of the potential downsides or risks that investors should be aware of when considering royalty and streaming companies?
That's a great point. It's easy to get swept up in the excitement of a booming industry, but smart investors always consider the risks alongside the potential rewards. What are some of the red flags that investors should be looking out for when evaluating royalty and streaming companies?
Well, one key risk is what's known as counterparty risk. Remember, these companies are essentially providing financing to mining companies. If that mining company goes bankrupt or runs into serious operational problems, it could impact the royalty company's bottom line. So even though these royalty companies aren't digging up the dirt themselves, they're still exposed to the risks inherent in the mining industry.
Exactly. It's a crucial point to understand. However, these companies aren't just blindly throwing money at any mining project that comes their way.
Right.
They're highly skilled at evaluating these risks and structuring their agreements to mitigate potential losses.
Okay.
They often include clauses in their contracts that protect their interests in case of bankruptcy or other unforeseen events.
So it's about choosing their partners wisely and making sure their agreements are watertight.
Exactly.
It sounds like a delicate balancing act.
It is. They need to find partners with solid track records and promising projects while also protecting themselves from potential pitfalls.
Right.
And remember, even with the most stringent due diligence, there's always a chance that things could go wrong.
Right.
That's why diversification is so important for investors.
Right. Don't put all your eggs in one basket, especially in a sector like mining. Spread your risk across multiple companies, different commodities, and even different geographical regions.
Exactly. Diversification is key to managing risk in any investment portfolio. But let's go back to those specific risks associated with royalty and streaming companies. Another one to consider is commodity price volatility.
That makes sense. Even though they often lock in below market purchase prices, they're still operating within a volatile commodity market.
Precisely. Their share prices can still be influenced by swings in commodity markets. This is particularly true for companies that focus on a single commodity like gold or silver.
Right.
If the price of that metal takes a nosedive, their share price is likely to follow.
So even with those fixed or below market purchase costs, they're not completely immune to market fluctuations.
Right.
It sounds like diversification across different commodities is crucial here as well.
Absolutely. And it's something that many royalty and streaming companies are already doing.
Fair.
They're expanding their portfolios to include a wider range of metals, from battery materials like lithium and cobalt to industrial metals like copper and nickel.
So they're not just betting on gold anymore.
Nope.
They're casting a wider net and embracing the full spectrum of the commodity market.
Precisely. This diversification not only reduces their exposure to any single commodity's price volatility, but also positions them to capitalize on the growth potential of different sectors,
Right.
like that clean energy transition we talked about earlier.
It's like they're hedging their bets while simultaneously positioning themselves at the forefront of emerging trends. Very strategic. But what about the operational side of things? We talked about how they evaluate the operational risks of their mining partners, but can those risks still impact the royalty company's bottom line?
That's a great question. Remember, even though they don't run the mines themselves, they're still reliant on those mining companies to deliver. If a mine experiences delays, cost overruns, or safety issues, it can directly impact the royalty company's revenue stream.
So even though they're one step removed from the day-to-day operations, they're not entirely insulated from those operational challenges.
That's right. And that's why those rigorous risk assessments we discussed earlier are so crucial.
Yeah.
They need to have confidence in their mining partner's ability to execute the project effectively and safely.
Right.
It's all about picking the right partners, trusting them, but also verifying their capabilities.
It sounds like it takes a special kind of expertise to navigate this space successfully. They need to be savvy investors, commodity experts, and risk management gurus all rolled into one.
You could say that. It's a complex and dynamic industry, and it's certainly not for the faint of heart. But for those who are willing to do their homework, diversify their portfolios, and embrace the long-term perspective, royalty and streaming companies can offer a compelling way to participate in the growth of the mining sector. And as we discussed, they have the potential to play a significant role in the global shift towards a more sustainable future.
It's a powerful narrative. It's not just about profits. It's about aligning your investments with your values. It sounds like we've reached the end of our deep dive into the world of royalty and streaming companies. We've covered a lot of ground, the benefits, the risks, the future outlook, and even the potential impact on the clean energy transition.
It's been a fascinating journey. We've seen how these companies are disrupting the traditional mining industry, offering new opportunities for both miners and investors. And as with any evolving sector, there's always more to learn and discover.
Absolutely. So to our listeners, we encourage you to continue exploring this space, do your own research, and as always, we'd love to hear your thoughts and questions.
The world of mining finance is constantly evolving, and staying informed is key to making smart investment decisions.
That's right. So stay curious, stay informed, and stay tuned for more deep dives into the world's most intriguing topics.
Until next time, see you then.
Thank you for listening to the Mining News Network. If you found this content helpful, please don't forget to drop us a like and subscribe. If there are topics or companies that you would be interested in or like us to cover next, please leave a comment down below.